Let's talk about your mortgage. For most of us, it is by far our single biggest monthly bill. So what if you could slash that cost and save hundreds, maybe even thousands of pounds? Well, that's not some hypothetical question, it's exactly what remortgaging can do. Today, we're going to break down precisely how to do it and land yourself a much, much better deal. So let's just kick things off with a really direct question. If you haven't even looked at your mortgage deal since the day you got it, chances are the answer is a big, resounding yes. You wouldn't believe how many people are overpaying without even realizing it, and we are going to show you exactly how to stop. Okay, so here's our game plan. We're going to start with why this is so incredibly important. Then we'll dive into the one key number you absolutely need to understand, your loan to value. After that, we'll cover how to boost your chances of getting approved, tackle the big fixed versus variable debate, and finally, how to actually go out and find the best deal. Let's get into it. So, first things first, why even bother with all of this? Honestly, it boils down to avoiding one huge, expensive mistake, the SVR trap. This is the financial pitfall that catches so many homeowners completely off guard right when their initial deal comes to an end. You know that nice, cozy 2 or 5 year fixed rate you started with? Well, when that deal ends, you don't just get to stay on it. Nope, your lender automatically and quietly shifts you onto its standard variable rate, or SVR. And let me tell you, this rate is almost always way, way more expensive. Staying on it is basically like volunteering to pay more for the exact same house. It makes no sense. Okay, so now you know why you need to get off that SVR. But how do you unlock those much cheaper rates? Well, it all comes down to two little things that are completely connected: your equity and a number called your loan to value, or LTV for short. All right, first up is equity. It sounds a bit jargony, doesn't it? But trust me, it's super simple. Imagine your home is worth £300,000 and you still owe £200,000 on the mortgage. That means you have £100,000 of equity. That's your slice of the pie, the bit you own outright. And honestly, it is your absolute superpower in this whole process. And why is this equity thing such a big deal? Because it directly dictates your loan-to-value ratio. Now, this LTV is just the percentage of your home's value that you still need to borrow. And lenders, well, they are obsessed with it. Okay, let's actually see this in action, because this is where it gets really powerful. Let's take a £200,000 house. If you manage to build your equity from just 10% up to 40%, look what happens. Your LTV plummets from 90% down to 60%. And the result? Your monthly payment could drop by over £400. That is a massive real-world saving every single month. So if there's one thing you need to remember from all this, it's this. This is the golden rule. The more equity you own in your home, the lower your LTV ratio will be. And the lower your LTV, the less of a risk you are to lenders, so they reward you with their cheapest interest rates. Simple as that. Right. So that low LTV, that is your golden ticket. But, and this is a big but, lenders are not just going to hand it over. You've got to prove you're a reliable borrower. So let's look at how you can get your finances into perfect shape before you even think about applying. What lenders are really looking for is a squeaky clean financial history. So for a few months before you apply, it's prep time. Get copies of your credit files and check for any mistakes. Make sure you're registered to vote at your current address. And whatever you do, do not apply for any other credit, like a new credit card or car loan. You want every single thing on your file to scream, I am a stable and reliable borrower. Okay, next up is affordability. This is massive. Lenders will go through your bank statements with a fine-tooth comb. So for the 3 months leading up to your application, you need to be on your best financial behavior. That means cutting back on unnecessary spending and just being really sensible. You've got to show them without a shadow of a doubt that you can comfortably afford these new payments. All right, you've buffed up your finances, your LTV is looking good, you're a model applicant. Now comes the big strategic decision. What kind of mortgage do you actually want? And it really all comes down to one key question. Do you go for a fixed or a variable rate? And this is the fundamental trade-off. A fixed rate gives you total certainty. Your payment is locked in stone for, say, 2 or 5 years. Think of it as paying a tiny bit extra for an insurance policy against sleepless nights. A variable rate, on the other hand, is more of a gamble. It might be cheaper to start with, but your payments could go up just as easily as they could go down. And this quote from Martin Lewis just hits the nail on the head. Because this decision, it's not just about the numbers on a spreadsheet, is it? It's about your peace of mind. If you choose the security of a fixed rate and then interest rates happen to fall, don't kick yourself. You paid for certainty, and that's exactly what you got.
Right? We are on the home stretch. You know why this is important, you know what kind of mortgage you want, and your finances are looking sharp. So, how do you actually go out there and hunt down the absolute best deal? Okay, here is your super simple 3-step battle plan. Seriously, it's this easy. Step 1, call your current lender. Ask them for their best possible deal for an existing customer. That's called a product transfer. Step 2, whatever they offer you, that is now your benchmark. And step 3, your mission is to beat that benchmark by using a mortgage broker to scour the entire market.
So, why use a broker? Well, think of them as your expert guide through the mortgage jungle. They can see the entire market, and that includes special deals you just can't find on your own. Most importantly, they know exactly what each lender is looking for, which massively boosts your chances of getting approved first time. You can go it alone, but a good broker can honestly save you a ton of time, stress, and, most importantly, money.
So let's end with this one simple thought. That introductory deal you're on right now, it has an expiry date. There's a day coming when it will end and you'll be dumped onto that eye-wateringly expensive SVR. So the real question is, what's your plan? You've got the playbook now, it's time to take action.